Hey guys, Tanner Larson here, and in this Car Talk, I want to go over your profit margin. I want to talk about margins specifically. So I was reading an article the other day from Marketing Sherpa talking about the difference between businesses that were, in the low six figures and businesses that were over $1 million in the e-commerce space. And the difference was that businesses in the six-figure range that were struggling and never really got beyond the six-figure mark were, on average, had gross profit margins below 30%, whereas the businesses above $1 million had gross profit margins in excess of 40% at the minimum. Okay, and then those numbers were skewed based on different, subsets of the e-commerce industries and different categories and things like that. But the thing that really drew me to that article and those statistics that was really important was the fact that these six-figure e-commerce businesses, of which there's many more than there are million-dollar e-commerce businesses, are struggling, and why they're still stuck in a six-figure business is because of their margins. So when we talk about a gross margin, this is something that people really get wrong anyway. They don't really realize what we're talking about with a profit margin. They just kind of gloss over it or think that the gross margin is the real margin. So the gross profit margin is the difference between what you pay for the product, the actual cost of goods, like what it cost you for that product, and the price you sell it for. Okay, so those are that's the major gross profit. So if you buy a product for $20, you sell it for $40, your gross profit is $20, or in this case, 50%. Okay. However, most e-com businesses, as this Marketing Sherpa study attested to, have a gross margin of less than 30%. Now, what that means is that's just after they subtract the cost of the product. That doesn't account for any kind of advertising, marketing, overhead, taxes, any other expenses of running your business. So let's say you have a 10% cost of acquisition, the cost of acquiring a customer for every product you sell. So it's 10%. And if your gross profit margin is 30% and you subtract 10% more for your cost of acquisition, now you're at a 20% profit margin, and you still haven't factored in your overhead, your storage fees, your internet, your salaries, anything like that, any of your actual fixed cost, variable cost, or anything like that. All you factored in is your advertising. So when your gross profit margin is so low, it makes it very hard for you to have any money left over. So, when you get down to your actual net profit, which is, the actual profit you have after taxes and any, interest or debt payments you have, that number can be very, very little. And so it's really important that you guys learn to build real profit margins into your business, and you understand the different types of profit margins and how they affect you and what your real numbers are. I would venture to say that if you actually did the numbers in your business and figured out what your actual profit margins are per product that you sell, it would be a very different number than what you tell people your profit margins are when you actually do it, and it would shock the hell out of you. So I urge you to kind of learn a little bit about profit margins and try to have a higher profit margin. Engineer one. So you mark your products up, no less than 150% markup, and then doing that gives you a rough number where most of the time you can get to a better gross profit margin, which gives you a better operating margin, which gives you an even better net profit margin. So in our business, we mark up our products in such a way that we wind up with a gross profit margin of no less than 60%. That's what, when we're looking for a new product, when we're getting ready to launch one or whatever, we make sure that we have a 60% gross profit margin. That way we have the ability to spend roughly, say, 20% on acquisitions and overhead, on advertising and overhead, and still wind up with a 35 to 40% net margin at the end of the day. So we want our net margin to be what most businesses' gross margin is. Okay, when you engineer your business like that and you build out these margins, it makes it so much easier to stay in business, thrive, and really pocket some serious cash. So think about your margin, do some math, figure out what your actual margin is, and see what you can do to make it better.